Hello, welcome to one of my most critical videos, where I will be discussing the impact of monetary policies on the economies and on your investments. Today, I'll be explaining quantitative easing, QE, and quantitative tightening, QT, and why it is important for you to understand how these policies affect the economy and how you can protect your financial wealth, and even potentially benefit from quantitative tightening monetary policy. Before starting the video, I would like to say that nothing will be the same as before. During the video, you will be able to generate new tips from the information I give and will be able to create much more beneficial strategies from now to the future. So, let's begin. Quantitative easing, or QE, is a monetary policy used by central banks to stimulate the economy by increasing the money supply. Central banks use QE to lower interest rates and encourage borrowing and spending. This is done by purchasing government bonds and other securities from banks, which in turn increases the bank's reserves and makes it easier for them to lend money. QE was first implemented during the 2008 global financial crisis as a way to jumpstart the economy and prevent a recession from becoming a depression. Central banks in the United States, Europe, and Japan all engaged in QE to varying degrees in the years following the crisis. While QE helped to stabilize the economy and prevent a deeper recession, it also had some unintended consequences. One of the main concerns is that QE can lead to asset bubbles in the stock and real estate markets, as well as increased inflation. As the economy began to recover and inflation started to rise, central banks began to implement a policy called quantitative tightening, or QT. QT is the opposite of QE, and it involves selling bonds and other securities in order to reduce the money supply and raise interest rates. When central banks engage in QT, it can lead to a slowdown in the economy and a possible recession. This is because when interest rates rise, borrowing becomes more expensive, which can lead to a decrease in spending and investment. Additionally, when the money supply is reduced, it can lead to a decrease in economic growth. It is important to note that QT can be considered as a normal part of the economic cycle and is often implemented as a preventative measure to curb inflation. If a recession does occur, it can have a significant impact on the stock market, real estate market, and other investments like cryptocurrencies. During a recession, stock prices may fall, and real estate values may decrease. Additionally, during a recession, many companies may go out of business, which can lead to a decrease in employment. On the other side, with the current geopolitical climate, there are additional factors at play that may exacerbate the potential for a recession. The ongoing trade tensions, war and other fragile actions between countries can lead to increased uncertainty and volatility in the markets as well as economic stability and health in the world. However, it is also important to remember that recessions, although difficult, are a normal part of the economic cycle and have historically been followed by periods of growth. By being aware of the potential risks and having a plan in place, you can help protect your finances and potentially even benefit from the opportunities that arise during uncertain times. Don't forget what I said. Having a plan. Despite the risks, there are still opportunities to make sound investments during times of uncertainty. Especially if you hold an important amount of cash, it would change the game for you. Regularly following the assets, keeping an eye for opportunities, finding those might be sold at discounted prices or can be considered close to long-term buying area due to market uncertainty, you will leave a big step to success behind. Because now you have a plan and you do whatever is necessary to be prepared and win. Meanwhile, keep an eye out for signs of economic recovery. As the markets begin to stabilize and the economy starts to improve, certain assets may start to rise suddenly. So, once you get the signal, you have to act before everybody acts. But don't worry. Not everyone will have enough money in their pocket. Cash is the king at this time. Holding a reasonable amount of cash during a recession or crisis can be considered as the most valuable strategy, as it allows you to take advantage of opportunities that may arise. When the markets are in turmoil, prices of assets such as stocks, cryptocurrencies, and real estate may drop, creating opportunities to buy at discounted prices. This is known as a fundamental principle of investing. But, by holding the cash, you will have the financial means to take advantage of these opportunities and invest in assets that have the potential to appreciate in value over time. Additionally, holding cash also allows you to be nimble and adapt to changing market conditions. It is important to note that if there is something as important as holding cash, it is having a diversified portfolio. In order to consider the diversification, Other strategies such as investing in defensive assets or hedging by considering market volatility would make great sense to be in safe. When the time comes, don't forget to diversify your portfolio to spread out your risk, so you can potentially minimize the impacts of an unexpected situation in the world, since there can be always a FUD, the negative news in the market. In summary, quantitative easing, QE, is a policy used by central banks to stimulate the economy by increasing the money supply. The consequences of QE are things like asset bubbles, inflation, and etc. Nowadays we suffer from its consequences such as high inflation, and central banks have already been implementing quantitative tightening, QT, policy, which is the opposite of QE. QT led to a slowdown in the economy and the recession is in sight. Make a plan, be loyal to it and get ready. Thank you for watching my video. If you like my video, please don't forget to subscribe and like so that it can reach to more people.